Hold on to your wallets, folks. We're diving into the world of central bank interest rate hikes, a topic that affects everyone from borrowers to savers. Interest rate hikes are here to shake things up. But what exactly are these hikes, and why do they matter so much? Let's break it down. Interest rates are like the price tag for borrowing money. When you borrow, you pay back the principal amount plus interest, which is essentially the cost of borrowing. When you take out a loan, you pay back what you borrowed plus a little extra, that's interest. This extra amount is what lenders charge for the privilege of using their money. Borrowers love low rates, savers, not so much. Low interest rates mean cheaper loans but also lower returns on savings. It's a double-edged sword, but who decides these rates? Enter the central bank. Central banks are the big players in the financial world, setting the tone for the economy. While your local bank sets its own rates, it's heavily influenced by the central bank's rate. The central bank's decisions ripple through the entire financial system. Central banks lend money to commercial banks at this rate, which trickles down to affect what consumers pay. This is why a change in the central bank's rate can have widespread effects. Now, central banks don't just mess with rates for fun. Their decisions are strategic, aimed at maintaining economic stability. They raise interest rates to control inflation. That's the rate at which prices rise. When inflation is high, your money buys less, which can be a big problem. Their goal? Keep inflation in check, usually around 2%. This target is considered healthy for the economy, balancing growth and price stability. When central banks hike rates, borrowing gets pricier. This means higher costs for loans, credit cards, and mortgages. This means higher mortgage payments, especially if you have a variable rate mortgage. These types of loans are directly affected by interest rate changes. Fixed rate mortgages? You're safe for now, but new buyers will feel the pinch. Higher rates can make homeownership more expensive, affecting the housing market. Higher rates also make businesses think twice about investing. When borrowing costs rise, companies may delay or scale back their expansion plans. And consumers like us become cautious about spending. Higher interest rates can lead to higher costs for goods and services, making us more budget conscious. Less spending can lead to fewer jobs and lower wages. When businesses cut back, it can result in layoffs and reduced hiring. But there's a catch. Raise rates too quickly, and you might trigger a recession, a period of economic decline. This is a delicate balance that central banks must manage. Like the US did in 1981 with a whopping 19% rate. This drastic measure was taken to combat runaway inflation but had severe economic consequences. Timing is everything, and predicting the future economy is tough. Central banks rely on a mix of data, forecasts, and economic models to make their decisions. Central banks have to be super careful with every move. Each decision is scrutinized and can have far-reaching implications. So, next time you hear about an interest rate hike, remember it's not just a number. It's a tool used to steer the economy, affecting everything from your mortgage to your job prospects. You'll know exactly what's at stake. Understanding these moves can help you make better financial decisions and prepare for the economic shifts ahead.